for this next session, I'm doing an interview with John Diddams, who's probably, from my perspective, I've been in this space for quite some time, and I've watched John. He's worked with over 20 IPOs over the last sort of 10 years. So this session's really all about how both founders and investors can really get behind the successful listing of a company on an exchange. So this session's really been driven around, the title of it is The Keys to Managing a Successful IPO. I'm joined by John Diddams, so please welcome and say thank you, John.
Thank you. Thanks for having me. Appreciate it.
So just to start with, do you want to give a bit of a background to yourself?
Yeah, sure. Going way back, I did a cadetship with John Lysart. I did accounting part-time at university. Worked for a while and then went overseas, spent 6 years in London working for an American oil company over there in their internal audit. Came back, joined an entrepreneurial guy, and we then started doing a few listings in the early 80s. I was the centre of it, doing all the mechanics of it, and they had all the ideas. So I learned a lot from these guys. By the early 90s, I thought to myself, yeah, I seem to do all the work but not get most of the reward. So I went out on my own, hung out my shingle and as a CPA, and started doing work on floats and other things. I employed a number of people in those days and did company secretarial work and accounting work and other stuff, as well as doing some listings and so on. I did find, though, after a few years that I spent more of my time administering those people and doing administrative without doing the stuff that I like doing, which was actually managing the process for an IPO. So for the last 15 or so years, I've been on my own and managed the IPO process for, as you say, 20 plus companies. I thoroughly enjoy it.
And to give context, like what are some of the names of the companies that you've sort of been on the board of and helped successfully list on the Australian Stock Exchange?
Okay, well, going from most recent.
Like most recent,
most recent was a New Zealand company out of Auckland called Arrow Biosurgery. They have a wound healing medical device. They're operating in the United States. They wanted to list on the ASX as opposed to the NZX, and they contacted me through some other contacts. And
just to note, we're actually featuring them in our IPO Spotlight session as well.
Oh, good. Well, you'll like Brian. He's the CEO.
He's actually an old client of Wholesale Investor. We worked with him sort of back in 2012, 2013. So great to see that sort of process of building, and then successfully listing.
Well, that was quite a successful listing. It was 75-cent shares came on at $1.40. So that doesn't happen every time, I'm going to tell you. But there were some peculiar things about that. We were going to go to the IPO in March, pulled it because of COVID, then had conversations between ourselves and the brokers and the potential investors, and we put in place a pre-IPO cap raise of 18 million on the proviso that within 3 months we did an IPO, and we pegged that too, so we had a 20 million guaranteed into the IPO. So that all worked really well once we got a bit of settling down on the COVID thing. Prior to that, the reason I was introduced to that one is I'm director of another company called Volpara, which is another New Zealand company out of Wellington, and they are in breast care and breast density and helping clinics to manage their process and their reporting to FDA and so on and so forth. So that's been very successful at IPO as well. I'm not just in the medical space.
Yeah, I was going to say.
I did the snoring and sleep apnea Somnomed float some time ago. I've done the indoor wind tunnel for iFly.
Indoor skydive,
I did a lot of reconstruction work with Skydive the Beach, which was a outdoor skydiving operation in Wollongong. We had to firstly reconstruct the whole company to undo all of the shareholdings and put them under one umbrella, and then make a public company, and then so on.
We'll get on to how you sort of help these companies in the structuring part.
So I just I tend to now. I used to do work as a consultant, but now I tend to find that it's better to be a director of the company. And the reason for that is it's better for the company. Because the CEO and the CFO and so on can continue running the business of the company. They've never done an IPO before, so it would be folly for them to try to run the process if they've never done it. They'd fall into all the little traps and so on. Whereas I've done as I said, 20-something. So I know the pitfalls, and I know the brokers, I know the lawyers, I know what's required for ASIC and ASX, I know the listing rules. So I manage that process for them as a director. And as a director, I share their responsibility, liability. I get full visibility, transparency of all the issues and so on. And then I take most of my reward in the way of equity, so I align my interests with that of the shareholders and the directors. And then I generally stay on the company board for a few years to help them in that transition, which is quite a tricky transition between being a private company and being a public listed company.
Well, so there's quite a lot to do. So just on that, so let's go sort of right back to the start with some of the companies that you work with. So when you typically, when you're looking at a company that's going to go to IPO, typically how does it start? Do you have the management reach out to you? Do you have one of their shareholders typically reach out to you?
Look, it's a bit of a combination of all those things. In some cases, I've had the founder reaching out. In some cases, I've had the investor that's been investing in the company over a period of years that wants to then see an exit for their investment. And so they reach out. Quite often, it's a recommendation from another director. I don't do any advertising. I've never done any.
I've never seen an ad from you.
And it's all word of mouth.
And from the time you first meet a company, so say you sit down with a rower biosurgery or indoor skydiving, what is the typical time frame you're thinking about? Okay, I've just met this founder. What sort of time frame are they giving themselves to go through typically the IPO process?
Yeah, that's a really good question, and the two are quite separate. I mean, for example, with Skydive the Beach, for example, they had a lot of reconstruction to do. So we spent a good year reconstructing the business and putting in place processes, procedures and so on to be able to make them into a public company before we even started the IPO process. So it was almost a 2-year process.
So just on the details of that component, are you helping them become a public unlisted company in the first step?
Yes, exactly. Yes, what they had, for example, I mean, I remember Bowie showed me his corporate structure when we first started, and it had 40 different companies on it, which owned drop zones and aeroplanes and people and hired people and so on and so forth. Now we had to bring all that together, and they're all different shareholders. It was himself and his mother and his trust and his super funds.
So it was almost like a roll-up.
So we had to do a complete roll-up of this business, as you say, and put it together. So that took quite a lot of doing. There were some other distractions along the way, but we got through that.
And how do you help the mindset of the founder? Because as you mentioned, it's a big gap going from being a private company to then public unlisted and then to listed. How do you help the founder sort of in understanding what they are, helping them mentally prepare for what they're about to experience going through?
That's interesting. It's quite a difficult process for a founder to get to understand that they've previously been running something that's all theirs, and now they're running something that they only own part of and that the public owns a part of. So they have to get across that mindset. But that's where I can help them, because I've done it so many times before.
You're the safe hands, right?
I sort of help. The most important thing is for the founder, the CEO, the CFO and so on to continue doing their job of running the business, so that the business doesn't fall over while they're trying to do this process.
And that's powerful, right? Because if you think about it, as a founder and as a business owner, you're always sort of pushing new ground, you're breaking new territory. Often you've got no one to follow. So if you're going through an IPO process and you understand the ramifications of that, if it's done poorly or if it doesn't quite work out as expected, it's a concern. So I imagine going to you where you do have, you mentioned before, the brokers, the lawyers, it's like, okay, it's something that I don't have to think about. That if I didn't have someone like you on board that's got that sort of been there, done that experience. So for me, if you've got them focused on driving, on building the business, how are you helping understand their capital requirements that they'll need to go through the process?
Oh, that really comes out at the start. I mean, when I talk to the business, I find out what their aspirations are, and what do they want to do? Do they need capital to expand? Do they need capital for marketing? Do they need new products or whatever? So we work that out first. And then we try to work out, well, what is the business worth today?
And what's the process you go through?
And that process is generally on a like-for-like basis. You look at peer group companies and so on, and you try to determine a value. It's never a definitive thing. It's always within a range and so on. And it's more of an art than a science, to be honest. And then once you decide that, you then decide, okay, how much do we want to raise to be able to execute on that business plan? And then we work that out through, and then we go back to the brokers and see what they have to say.
So you said go back to the broker. So when you're trying to get that, okay, so trying to understand a sort of valuation of business, are you taking a few friendly brokers or fund managers? Okay.
Absolutely. You've got to get everybody on side,
Yep.
right from the start, and get everybody. I like to use the expression, get everybody in the same boat rowing in the same direction.
Yep.
Because if you've got one person that's out of order, then it doesn't work very well. And that includes the lawyers, the accountants, and you've generally got at least two sets of accountants. You've got the auditors, and then you've got the investigating accountants that look at the prospectus and so on. And then you might have the PR firm and so on. You might have an industry expert that you want to opine on that industry so that you can say, well, because if it's a complicated industry, you want someone to be able to distill all that for the average investor. Because a lot of these companies, a lot of businesses are quite complicated, but you've got to simplify it down. You've heard the expression, the elevator pitch. Well, that's what you've got to do. You've got to be able to tell them what it's about within 3 or 4 floors.
It's actually one of the hardest things as a founder is that you think about, you spend day and night building your business, but really when you go through even an IPO process, you've got to get it down to almost 3 bullet points, explaining sort of what you do. And then, obviously fund managers ask more technical questions and so forth, but it's one of the hardest things in the world trying to distill that simple message, the simple growth strategy, and also why you believe it will be a successful IPO.
And the other part of that too is that if you leave it all to the lawyers, and I'm not being disparaging about lawyers, they've got a very important role to play, you'll have a prospectus that's absolute boilerplate. But there's no story, and you can't sell it. Well, and if you leave it all to the PR people, you'll have this fantastic story, but I'm not sure that you'd really want to do that because of the liability that might come from some of the things. So my role is to try to bring those together so that you end up in the middle with a good story that's accurate and truthful and can be presented to investors, but at the same time, you're not going to have ASIC looking over your shoulder and saying, you can't say that or you can't do that. So, and then you've got to take it to the ASX and get it past the ASX as well.
Now, just before that process, okay, so you've gone out, you've got some you've spoken to a few brokers, you're trying to understand what the valuation is. Let's say you've got your hands on a valuation range. Is there a percentage of the company that you're looking to raise capital for in the IPO? And are you often sort of thinking about a pre-IPO strategy that helps sort of build momentum into the IPO?
Yeah, that's a good question, but it all depends on the circumstances of the time. The valuations generally come out about where you think they're right. If you get a company, I'll give you an example, when Facebook listed, Mark Zuckerberg took $3 billion off the table and the float was pretty much a flop because the price went down afterwards. Now, I don't know about you, but I could probably live on $2 billion. So if he only took 2 and left a lot more on the table for the other investors, it would have been a much more successful float earlier on. It's come back now since then, obviously. But what you've got to make sure of is you make sure that what you're doing is fair right across the board for everybody. That the new investors are not putting their money into something when the founder or the old investors are taking it out. You don't want that. The new investors have got to be sure that some of that stock that the old investors have is escrowed so that they're not selling and running off on day one and so on. But at the same time, if someone like a founder has been working in the business for 5 or 10 years and he's mortgaged his house and done all these things to build this business, then you should allow him to be able to take some money off the table to fix his financial position because then he can be focused 100% on making the business more successful for all the new shareholders. So there's a balance there. And, I've seen it at all ends of the scale and, I think I've got a pretty good idea now of what that balance looks like.
Gotcha. And it said, whilst you said it's a balance, I imagine you've got a sort of typical sort of amount of equity you're looking to, as a percentage-wise, of the company you're looking to allocate for that process?
It's not necessarily a percentage. No? It's more to do with the business plan, and it's more to do with how much money does the company need to get it to execute its business plan. Now, there's if it only needs 20 mil, and let's say the company's worth, just for sake of argument, 100 mil pre-IPO, and you raise 20. If you can get that 20 million to make the company worth 200 million in 2 years' time, that's a great exercise because then everybody's benefited from the money going. There's no point going and raising 50 if you only need 20 and leaving 30 in the bank. There's no point, because what you've done then is diluted all the existing shareholders
Yes.
too much, and the new guys have come in, and all they're going to get is interest on the money. That's not.
Yeah.
So you've got to keep it as tight as possible, but have enough money to execute on the business plan.
And
so
when
the
you-
percentages don't really matter.
And with the execution of the business plan, are you thinking across a 2-year period, a 3-year period, a 5-year period? Like, obviously, as far as the allocation of capital.
To me, it's a minimum of 2 years
Yep.
to see where the company's going to be in 2 years. And that might mean that the company needs to raise more equity in 2 years' time if it's kicked its goals. If it hasn't kicked the goals, then there's a problem. So you've got to make sure that, firstly, anything that you promise, you can deliver.
Yep.
So that's as the business. And then secondly, that you've got enough capital to make sure the business can run for at least 2 years to either get it to break even or get it to, cash flow positive, or get it to, double profitability or whatever. It's not the end of the world if you need to raise more capital down the track, if you've been able to kick those goals along the way.
Makes sense.
So there's no real rule there. That's
Now, so you've...
water.
Sure, go for it.
Yep.
So basically, okay, so the next part of this is now going on the roadshow component, right? So you've got people in place, you've got your strategy in place. What sort of advice would you give for a founder or investors backing companies that are thinking about going through the IPO process? What would you think? What advice would you give them about the IPO roadshow process?
Yep. First thing is know your business.
Yep.
As a founder, you've got to know your business, but you also got to know how you can sell it to someone else. The business, not the product or whatever it is. And then you should also have next to you your CFO, who should have unbelievably good knowledge of his numbers. If he doesn't have good knowledge of the numbers, then the people start to worry a bit. You've got a good board, you put a good board around you. As I said, I always join the company as a director, but I rarely take on the chair role, because I'm more of a nuts and bolts, the roll up the sleeves and get the process managed.
Yep.
I like to have a chairman that can look at the big picture, the strategy, the industry, and so on and so forth, so that you've got that. And then another couple of 1 or 2 non-executive directors, and obviously with diversity and so on as part of that. And that gives you a good then balanced board of 4 or 5 or 6 people with different skills to take forward. But going back to your original question, that process, you have to make sure that you know your business inside out, because the investors, they'll know. They'll know what questions to ask.
And typically, what is it? Is it a month-long process? Is it a 2-month, 3?
No, by the time you get to that, I generally join a company, 8 to 10 to 12 months before it lists.
Yep.
Because there's a lot of work that's got to be done beforehand as well. Corporate governance work's got to be put in place, all the right structure, and so on.
Yep.
So you get all that done, and then you appoint your lawyers and your brokers and your accountants and everybody else to do the IPO. You start the process on the prospectus, and then you write the prospectus. Now, the CEO is going to tell you the story, and then others are going to have input into how that story is told, but you've got to tell it in the most succinct way, but enough to get the message across, and as I said before, enough to make sure that you satisfy all the regulators, so that you don't end up with a problem afterwards.
Yep, gotcha.
And half of that is down to the due diligence process itself. You start with a planning memorandum, and you work out this is the plan, and then you stick with the plan on the way through. You have, I generally have due diligence meetings every 2 weeks, same day, same time, Wednesday, 11 o'clock. 2 hours, and everybody that's got an interest in that comes as part of the due diligence committee, and then there's minutes produced, to-do list, and an outstanding issues list, and so on. So everyone knows where they stand.
Yeah.
And then when I finish that meeting, I then give a report to the directors separately, so they know what's going on, because the directors are ultimately responsible for this prospectus.
Yeah.
They have to carry the can if something's wrong.
Yeah.
And if I'm a director, I'm going to make sure there's nothing wrong, because I'm sharing their responsibility and their liability. We've had supplementary prospectus in my time, but I've never had any prospectus of mine ever subject to any legal litigation whatsoever.
Gotcha. So now we're going to the process, and we're getting closer to the IPO.
Yeah.
And I there was a famous journalist that used to basically cover all the IPOs, and I remember having a chat with him, and I asked him what his advice would be for companies, and I remember him telling me he used to get really frustrated with CEOs because they would make all this noise and do all this talking and so forth, and they'd be happy to do interviews during the IPO process, but then after the company would be IPO, there would just be silence from them. So what guidance would you give to CEOs that after they've listed their business, how to manage that investor relations to not only keep their existing investors up to date, but to also attract future investors as well?
Well, it's very, very important. That's a very good question, actually. A CEO of a public listed company should spend a third of his time on investor relations.
Wow.
A third of his time.
Yep.
Spends a third of his time on the business and the other third of his time on managing all the people and so on and so forth. So, but a third of his time on investor relations, should have a good investor relations firm. You always set out a program before the event. So, you know, I can help with that so that everyone knows in the next 12 months what things you've got to put out to comply with the stock exchange regulations. And then you look at ASIC and say, well, okay, we've got to have a manual meeting here, we've got to have this here. You might have quarterly reports for the ASX on the cash reports if the company hasn't had profitability up to that point, so there's certain regulations there. And then you overlay that with, well, if it's, for example, a medical device company, when do you think you're going to get FDA approval for that particular thing? Well, we think it's going to be then, so there's a milestone. So we want to put that in. Now, you don't go and overpromise. You don't say it's going to happen on the 1st of November, because if it doesn't, then everyone goes, whew, what's happened? So, but you say, we're expecting that within the first half. And then when you get it, then you make that announcement.
Gotcha.
But you've got to be very careful not to overpromise and then under-deliver.
And I was going to say, life science is a hard one, because I've heard of so many different deals where they're literally waiting for sign-off on a contract, and the person that's signing off could be on holidays or something like that, and that's the reason it's delayed. Now, final question for this session. What are some of the key traits that you've seen in some of the most successful CEOs that you've worked with and gone through the listing process with?
Passion is the first. The passion for the business, passion for the product, passion for the service, passion for what they do. For example, you know, the most recent one, Brian Ward, the CEO of Arrowa, he's been in that business for 10, 12 years, and he is passionate, and he understands it, and he knows it extremely well. And that's contagious. That permeates all through the thing. If you've got another one, I'm not going to mention any names, but if you've got somebody that's only there for the ride, that doesn't have that passion, you know, it soon gets found out, and it's not as successful. Well, John, thank you very much for your time. So I appreciate to have someone of your experience and skill set join us for this session. Thanks. Look forward to having you on for future activities. Oh, thanks a lot, Steve. I appreciate it, and enjoyed doing it. Thank you. Thanks, John.